All right, good afternoon, everybody. Event Trader here, about to be joined by chart trader Brett Manning. Of course, Brett, you there?
Sure am, Gav. How you doing?
I'm doing good, and looks like we get some toys to play with here right off the bat as the Powell headlines are crossing, and a quick Nikkei one that we could touch upon in a second. But real quick, just for anybody listening, going through the Powell headlines. Saying the Fed will soon announce measures to add to reserves supply over time. This had been expected. This is, of course, in reference to the balance sheet and the repo experiment. I think it was 150 to 200 billion was the numbers that I was seeing around there for that. So we'll look for a little bit further color. But the Fed, Powell is addressing the balance sheet here, saying that the time is now upon us for the Fed to expand the balance sheet to maintain appropriate levels of reserves. So this looks like it's going to be a longer term move, not just something in the short term. A lot of focus on the balance sheet here, given these headlines. Growth of the balance sheet for reserve purposes should not be confused with quantitative easing. This has been laid out by him before. It says jobs inflation picture favorable. That would be, of course, after the PPI numbers that we saw, which Brett and I will touch upon in a little bit, noting that the continued economic expansion, strong labor markets, and inflation are near 2% goals is most likely outlook. Again, in line with what he said in the past. Global developments pose risk to the favorable U.S. outlook. No surprise there. Saying the Fed will assess the outlook risks on a meeting-by-meeting basis. Again, language that has previously been used. Said policy is never on a preset course, will change as appropriate. No surprises here, Brett. And I know that there's some talk that Powell wouldn't strike as dovish of a tone as had been in the past. We're seeing the markets, or some had hoped, I should say, and I would say that this kind of falls into that. I see the markets popping, and my guess is it's on that balance sheet expansion commentary, which I think was generally expected. So I'll be curious to see if we could hold on some of these gains that we've seen leading up into this speech, because I would think that people probably were hoping for a little bit more of an implicit mention of a cut, and I thought that the best way for him to do that would be the mention of the PPI. Obviously, he's not going to get involved with one data point offsetting some of the other data points that we've seen, but certainly one of the weaker measures of inflation that we've seen over time. And the PCE number, even on a year-over-year basis, has been running a little bit lighter. Also, real quick, Euro's seen a pop here, as is gold. No real big surprise there, given some of the commentary, and I think it's just really Agos picking up on that balance sheet mention. Brett, going through all this, what's your take?
Yeah, no, I agree with pretty much everything you said. We're looking at Fed funds now at about 80% for October, so I think that's already basically priced in.
I haven't checked December yet. What's December at?
December right now
for like 50 basis points between the two.
No, I gotcha. It is 37.6% to get to 2 cuts by the end of the year.
Okay.
So it is not the base case view, but it is moving up fast.
What was it like, say, a week ago?
A week ago, I think it was around 10%.
Okay.
So yeah, we're pushing up, and yeah, I mean, I think that the market is obviously there's the generalized turmoil of the news cycle, which is certainly picking up steam, and then we're living in the shadow of the ISM data. Basically, everything that happens now exists in the shadow of that ISM report as the defining sense of, oh, here's a piece of economic data that has a strong track record as a leading indicator that confirms the basic sense of of what the yield curve has been saying for a while. So we're kind of in that shadow right now, and I think that the conversations that have to do with the balance sheet, the way that Powell just addressed it, are really technical and liquidity based rather than solvency based, and I'm not sure they really do apply to notions of monetary policy overall. And I think looking at it as QE is wrong, just like he said. So I think that any reaction that is happening right now based on that is really probably going to be quickly reversed if it is just about what he said about the balance sheet. But otherwise, it was a relatively dovish tone.
Yeah, and just keeping an eye here on futures, Nasdaq trading near its session highs here at 29.15. It's really regained all those early losses that we saw. That was post PPI and that little dip breaking below the 29.20 area for the Nasdaq for its part. Um, Seeing it bounce up right against that 7,700 level. It's just below that at 7,692. So far holding the gains from the Powell headlines.
I
We
would
obviously
note
have
that the euro is now at new lows and like a rocket
the Euro's reverse style aggressively. Okay.
downward. Yeah.
All right, and gold seeing a little bit of a reversal too. The TLT that's dipping down, and quick look up here at the 10-year yield. We've got that. That's popped up to 155.3 at the moment, so that has moved back to regain all of its early losses post PPI as well. So, okay, Brett. So we've got that. Powell's going to be continuing to talk. There is a Q&A session. So if there's anything that pops up, we will definitely address it. Let's see, Nasdaq just getting hit. It certainly looks like equity is taking this as a more dovish statement than.
Let's. I mean, this perfectly dovetails into our conversation because the difference between,
Sure.
say, the euro, the difference between gold and the Nasdaq is sentiment data. So everybody's stacked long gold and stacked short the Nasdaq. So the fact that gold, that if there's a headline that comes out that wants to push both of them higher, so that would be monetary stimulus coming at you, pushes gold up, pushes stocks up. Stocks are going to have the more sustained move, and that's because of positioning. And it's the fundamental thesis for why we do this show in the first place. Is that the reaction is stronger in stocks, it's going to be more durable in stocks, because you see something like, what we talked about at the end of last week, 10-day CBOE total put call average at 1.14, which historically means it's really hard for the market to go any lower because people are so overwhelmingly hedged and so overwhelmingly fearful of sustained downside that they're so positioned away from equities that there's really nothing but upside for equities the second there's any ray of sunshine. So, but gold is just the opposite. We have the all-time largest speculative long position in gold right now, so it's tough for it to sustain new moves because it's actually positioned just the opposite. So many people are betting on gold to go up that it's tough to find new money to come in, and it's easy to shake out the longs. So it's a more durable upside for something that's heavily shorted or heavily hedged in a situation where you get headlines like this.
Okay, Brett, I guess since we're on that topic, we might as well address some of the positioning with that first. And one of the things that was jumping out to me was the small trader put buy, and I know you've mentioned it a number of times. And one of the things that I saw was the 10-week average for this is at its highest ever. Recording. So I definitely found that to be pretty interesting because that certainly shows some of the protection that people are putting on out there. I think well, it's tied actually with October 2002, which obviously would have been probably a lot of small traders that were buying a lot of the internet names and probably looking for some downside protection as that started to slip apart. But what's your initial take on the positioning there? I know you kind of mentioned it here right now with the talks about people simply aren't positioned for a dovish move upwards, and that can lead to the little bit more of the of stocks holding gains. So when I throw out something to you with that 10-week average, I believe it's a 10-day average you usually go off of for the put call ratio, correct?
For the total CBOE, yeah, but for the small trader put option, I mean, a confluence between a longer average and a shorter average is usually really decisive in something like this. So, because when you have a risk-off sentiment that festers, that really builds up over time, it creates a larger and larger vulnerability because people tend to develop an association with a market in terms of its potential that just kind of becomes ingrained, and that creates an opportunity for some kind of catalyst or something to come along and inflect that attitude. One of the best examples, I think, is really around bonds during the Brexit period. But there's that sense that builds up over time, where there's just no opportunity, and then when you get an inflection out of that, there's so much money that can come into the situation to reverse that because it's been so ingrained. And I think that looking at a 10-week average of this small trader put purchases is a reasonable example, and it's right exactly where we were, essentially at the very bottom of the bear market that followed the dot-com blow up, right in like mid to late 2002. We're there right now, and if you think about retail market participants, and that's your small options traders, retail market participants, that was the biggest retail bear market in modern history, what we came off of with the dot-com blow-up. That was a market where during the late 1990s you had an unprecedented amount of retail traders starting to participate in the stock market in a way that they hadn't had. And of course, part of that is because they had access to the ability to do online trading for the first time, and at gradually reduced commissions. And that really wasn't something that happened in the 1980s or the 1970s. So the late 1990s bull market was special because it really introduced the idea of a mass retail market participant that was sort of real-time and independently driven. And if you think about where we were in 2002, by mid-2002, we were at the ultimate depths of the greatest amount of pain and the greatest amount of pessimism for that exact same contingent in the market. And it's remarkable to see that we're at that point of put purchases by those same traders right now, as if we've been through some terribly desperate bearish development. And yet the market is just a couple percent off all-time highs. So it really captures what's so odd about this market right now, that we could see such a quick move towards such extraordinary pessimism with so very little downside.
Right, and with that, Brett, I thought I came across an interesting article that I was curious as to your take on it. It plays into this certainly with the positioning, and it was basically titled "Bad September for Hedge Funds." It was a Wall Street Journal piece where they're noting that hedge funds were having their worst month for hedge fund long bets since April 2014. This was according to Morgan Stanley. April 2014 is when we're having that mini tech meltdown. A lot of the high-flying tech names that were getting that valuation was being brought into consideration were really getting chopped down, like Splunk, names along those lines. We're seeing the same thing in the month of September with a lot of the new IPOs, of course, a lot of the cloud plays. And one of the things that was sticking out was that a lot of the losses for these hedge funds were due to those style factors and being involved with those names. And
April 2014?
Yeah.
That is so odd to me. Really? Okay. I mean,
so why does that strike you as odd?
Well, if you look at the major indices, that's the most boring month ever. In terms of there's no movement. The market is just basically sideways, sitting at all-time highs. So It's interesting how that just didn't at all compute through to index movement. April 2014. That's amazing.
Yeah, I mean, just it was similar times where we were just seeing a rotation more into the value names. But, I mean, 7% of the money raised in the offerings for were raised in offerings from companies that can't turn a profit for these hedge funds. There's only 1 year where that number was surpassed, which was 2000. So again, with this put call ratio,
I'm sorry. Say that again. What was
so
the
70% of the money raised by hedge funds to buy these offerings were in companies that can't turn a profit.
You talking about IPOs?
Yeah.
Oh, okay.
Well, so offerings and just equity purchases,
secondaries, etc.
Yeah, exactly. It was all in companies that can't turn a profit.
And that's now.
That's now. Correct.
Yeah, that certainly sounds like a cycle-topping kind of situation.
Right, and it was only surpassed in 1 year, which was in 2000. Again, a little bit of a matchup to the internet bubble, and I guess that's kind of the point of what I'm trying to make here with some of these hedge fund positionings. And and the put call ratio, where it just really shows a lot of that internet bubble that we were seeing from 98 to 2001, which of course came crashing down. We're seeing a lot of the same numbers there. One of the things that was interesting too from that, and this was, I got this from Sentiment Trader, was so 86% of the money issued by hedge funds for trading in 2000 was to companies that weren't making any money in a growth hedge fund portfolio.
Right.
So the last 2 years have been the second highest at that, with 44% in 2018 and 69% in 2019. So again, it feels like a lot of these companies now have been unloading these stocks, just trying to get out, and that's what we're seeing. A lot of these crashing. Could potentially be some further downside in a lot of these growth stock names when you start looking at numbers like this. But when I'm throwing all this information at you, what's your take on that, Brett?
Well, I mean, I've certainly noticed that there is we've built up in Silicon Valley in a second market context a really odd cycle that I don't think has ever really happened before, where a lot of these companies, I feel personally, like a lot of these companies stayed private until they basically went through most of their major second derivative growth curve and then went public. And you see a lot of these top players end up getting out with a big exit before it really ever gets on the public market. And the public market is such an afterthought now. And so you're seeing something like an Uber. I mean, if you go back 20, 30 years, a company with that sort of growth potential would have gone public so much earlier, and so much more of that growth would have been something that, your average publicly traded equity investor would have had access to. And and we're talking top line growth. My position is still, and we've talked about this before, I think Uber and Lyft are generally, I think they're companies that are destined to never turn a profit. And so I understand where that selling is coming from. I think that is an artifact of a scenario that really has more to do with where you're most likely to see autonomous vehicles, and I think that it's probably as public sector transportation. But I think that narrative, a lot of the big investment dollars came seeded as a premise of autonomous vehicles in something like Uber or Lyft. And if that becomes a public sector transportation a story, then, they end up never really seeing the sunshine. But I certainly know the cycle end is often defined by people. And if you think of the turtles back on Turtle Beach, we're talking about the cycle being defined once again on every level by the process of people saying, well, is reality going to be better tomorrow than it was yesterday? And that's really hard to say early in a cycle, and it's almost an afterthought of an assumption late in the cycle. And when you're into that part of the cycle where it's so obvious that tomorrow is going to be better than yesterday, in terms of the credit environment, in terms of credit-worthy borrowers, in terms of spending, in terms of just about every factor you can think of, from households, banks, and companies. You're less likely to lose your job. You don't need to save as much money. It's easier to get credit. All these things keep getting better and better and better throughout the cycle. And I think it inures people into the idea that tomorrow's always going to be better than yesterday. And that's kind of like leaning out over top of skis when you're going downhill on a ski slope. And eventually you get to the point where you're leaning too far out over your skis, and that defines cycle end. And I think the idea that you have a lot of people who are professional investors raising lots of money and then putting it into companies that may never turn a dime of profit is kind of a way of really characterizing that kind of phenomenon. And I think, if tomorrow was truly always going to be better than yesterday, then these bets would all pay off, but eventually tomorrow's worse than yesterday. And, that's where you get the vulnerability turning into a manifest problem.
All right, and just as we're talking here, markets continuing to press higher. Looks like people are certainly liking that discussion around the Fed getting back more involved with QE light, if you will. One of the areas that are really gaining steam from this are the financials, because the talk is to buy some shorter-term T-bills, which should, in theory, deepen the slope and thus provide a little bit more of a benefit for the financials given their business models. Or steepener, I should say.
Yeah.
So just continuing to watch this action here, getting the the alerts from by Nasdaq and E-minis as this continues to squeeze higher. So continuing on, Brett, with the positioning here, Bank of America Flow Show last Friday. They showed 10 billion flowing into bonds, 6.6 billion out of equities, pretty much in line with what we've been seeing throughout the course of the year. One of the things that I thought was interesting on the equity side was about 2.1 billion actually flowed into ETFs, while 8.7 billion flew were flowing out of mutual funds. Is there anything you take from that? You think it might have been a lot of flow into the inverse ETFs that we were talking about last week?
It certainly matches up with the data that we got from Sentiment Trader. Yeah, I mean that was the big data point to certainly jump out, and one of the reasons why it was. I mean, the hardest thing to do, the hardest market to trade, at least for me, because I always try to have tight risk controls, is a situation where the market is moving on headlines in a direction that everybody's already positioned for. That is the hardest thing to trade. So last week, one of the most difficult points was we saw bearish sentiment data develop early in the week. We saw inverse ETF volume and assets shoot up before a lot of the primary downside, but the downside was driven by that ISM data, which seemed to confirm the idea that we may be on the doorstep of some recessionary data coming across the board. So that was a fair reason to say, you want to get out of risk assets, but people were already so positioned for that. So the downside becomes extraordinarily difficult in terms of pattern construction, where you put your stops. It's so easy to get stopped out of a situation where you're shorting something that's going to go lower, but everybody else is already sitting shorted as well. And you get the most difficult kind of shakeout moves along the way. It's really better to wait for some kind of headline to come along, something to squeeze people out, and then to turn and short that, because ultimately the big money is still going to be selling. But you want to get the weak hands triggering out of those shorts first. And we didn't really get any positive headlines at the same time. Ultimately, we ended up rallying because we so thoroughly drained the downside on that services number to kind of back up the manufacturing number. And it just kind of, it kind of fed through the entire process without ever really giving an easy setup on the short side, even though the market was being pushed lower by reasonably important catalysts. So we ended up in that situation. But yeah, as far as the flows are concerned, it would match up very well to say that a lot of this was buying of inverse ETFs, given that we spiked up that number so dramatically, actually during the first half of the week last week.
Okay, so just continuing to keep an eye on this action as we move forward. So we've talked a little bit about the flows. We dropped upon on the sentiment with that small trader put buying being the big item jumping out to me. Of course, the economic surprise index has been faltering a little bit with some of the misses that we've seen. So just curious if you've got any thoughts on the recent economic surprise on, we discussed the ISM services number. Do you have any insight into, say, for instance, the PPI or the jobs report from last Friday that was jumping off the page to you or impacting how you're trading right now?
No, not really. I mean, I think that is either a situation, again, just like we talked last week. I don't think we've resolved the dichotomy where you have people who are either too pessimistic in where they're in a purchasing manager position, or you have a leading indicator situation that's going to start to come to fruition, and the flower is going to really blossom on the stem as far as some of the negative implications of the ISM data, which is really a forward-looking data point. It should, in theory, lead to less hiring, less spending, and a self-reinforcing feedback loop to the downside in a lot of the hard data that we're looking at. But we haven't necessarily seen it show up in the hard data, but the prepotency is there quite obviously, and that's led to a lot of the positioning data that has made it so difficult on the short side. When you see some of the hedging data, and for instance, we can show you a chart in a little bit that shows. I actually posted this last week, but it's the average 10-day average of the CBOE total put call, which really shows, I think, everything in a sort of dramatic and obvious manifest display of where positioning is relative to other periods over, let's say, the last year or two in terms of where people have been. Back, I think the chart goes back to maybe late 2015, showing repeated instances of when we get up to a 10-day average put call of 1.14 on the CBOE total put call average, where it's led to an almost certainty of some kind of market bounce. And that's where we got to last week, right off the ISM services, is such a, it's what I called a high ceiling, or I mean a high floor. A high floor in the market really is about, I think, the relationship between interest rates and dividend yields on average in the S&P. Because the type of money that's coming into equities, because of where interest rates are, because we have 14 or 15 trillion dollars of sovereign debt around the world in negative interest rates, and because we have so much in the way of forward future certain payouts in terms of future liabilities like pension funds having to pay out, or insurance companies having to pay premiums, endowment funds, some of the arrangements that sovereign wealth funds have come to. We have a lot of investors particularly in the fixed income markets, that have to make payments out based on market returns with invested capital, and they want to do so with something as certain as an interest rate. And when you get so many fixed income instruments that are supposedly risk-free with a printing press behind them at a major sovereign issuer, and those rates are plunged into negative territory, they're not going to speculate on capital gains from the price move in the bonds. They're looking for that coupon. And when the coupon is buried below the needle, you see them looking for something else that they can depend on. And any kind of shakeout in equity markets where you have high dividend paying stocks, I think that's where that money goes. And I think we saw the same thing in early 2016 and in mid 2016 when we got around that Brexit period, where I think you saw a lot of money coming in from what I called at the time the refugees from the fixed income market, where everything is in negative yield territory in sovereign debt around the world, and they need to get some kind of return. And again, I think a pension fund model is a reasonable one, because they already have a contractual obligation to make payouts, and they have to get some kind of return. And if they're modeling, 1 to 3 to 5% interest rates, and you've got negative 1% interest rates, they have to find another means. And I think that when you get an S&P dividend yield that moves well above, let's say, the 10-year bond in the highest paying sovereign debt market in the developed world, you're going to get a lot of money moving into the S&P looking for dividends, particularly on shakeouts where you've already dumped some money out, and you have an opportunity to see valuations improve, and they get a little bit more confidence about the idea of their risk on the price move side, so that they can just capture those dividend yields as a basis for meeting their payouts. And I think that causes the market to have a high floor. And I'm starting to entertain the idea that we're in a similar situation now with the move in interest rates that we saw over the last few months.
Okay, real quick, but we're getting a reversal here, but it doesn't look like it's on Powell headlines. It looks like there's a headline about U.S. imposing visa bans on Chinese residents linked to Xinjiang abuses. So it looks like they are targeting specific Communist Party officials at this point, probably similar to what we've seen them do with Russia in the past. So that uptick in the trade battle.
So that's not particularly optimistic right in front of getting around the table.
No. Perhaps they wanted to make sure that Powell was buying the treasuries before they announced this. I don't know, but we're seeing an aggressive reversal lower, and this is why it's so difficult to trade this market right now.
Oh my gosh! Yeah,
we'll see if that 2,900 level holds. It's holding at the moment here, so we're going to continue to keep an eye out on this action as it plays out in front of us. So, do we want to get into some of the Chinese news at this point, Brett, since we're kind of being given things, or did you want to pull up that chart that...
You want to pull up that chart. I think that it's interesting for people to take a look at it, and I can explain what it's showing.
Okay, give me 2 seconds to get that up on the site.
Okay. And just as a preview, guys, this is a chart that I posted last week. You're going to see a black line chart of the S&P 500 over the course of the last roughly couple years, maybe back to 2015, mid-2015. And it's also got an overlay of the 10-day average CBOE total put call. And there's a line in the sand that I've noticed over the years, right around 1.14, where you tend to get a very difficult. It's a very difficult scenario for sitting in large short interest to try to push on the downside further when you get a put call that's kind of piled up like that. Over the course of 10 days, if the average put call gets up above this level, you'll see the data on the chart, and perhaps you've already seen this chart, where it's tremendously well correlated with bottoms in pullbacks in the market. And sometimes you see it after a long ways down when you see a lot of selling, like we did in December. Other times, you barely pull back off the highs and you already see that. But usually that's an indication that it's not a good market to be aggressively short of when people are that trigger happy. And there's really, I would say there's two dimensions to sentiment data. One is where the sentiment data is, and one is where the sentiment data is vulnerable to quickly becoming. And this environment seems to be defined by the sense that it takes very little downside to cause true extremes in bearish sentiment, which again suggests this notion of a high floor of alternative sources of capital. Basically, you get cyclical equity investors getting very bearish, but the market's not able to really just plunge because you've got some other capital coming in. So you get these really high put-call ratios on these relatively short declines, and this chart kind of depicts that. And I don't know where we're at with getting that up on the screen, but I think it's an extraordinarily interesting chart.
It should be up now.
Okay. So, yeah, there you go. So you can see the red line. The red line is the 10-day average put call, and you can see where we got to just last week. We got right up to that 1.14 level, 1.1427, which again, all the green circles that you see there are corresponding moments with getting to or above that line in put call, and almost all of them are essentially perfectly timed bottoms in pullbacks in the market, going all the way back. And there is no instance here where you see put call get up to or above that line where you basically aren't right at a bottom. We've had a couple back. If you look at maybe January 2016, we had sort of a retest after the line got there. And it kind of tried to push through, wasn't able to, and then rebounded. But in each instance, if you're buying right around when you see that line, now it can plunge further as the line, as put call moves higher. The only time we've really seen that significantly, though, was, I would say, December of last year. We saw an extra little bit of an extension to the downside, and we saw that put call average move up to close to 1.3. But it really basically just says, look, people aren't going to sell that much when they've already sold their core holdings and they've gotten to where they're buying puts instead. They're buying insurance because they don't want to sell what's left. So they're insuring with major index and specifically targeted hedges. So they're basically not going to lose money when the market goes down further at that point, when they've built up that level of hedging.
Hey, Brett,
so it's tough to move down.
Let me ask, how much is that kind of complacency? Because obviously there's been some pretty good returns at the beginning of 2019, particularly if you jumped in around right after that December Christmas Eve massacre. Do you think that, given all the headlines, the idea that we've kind of just been holding steady here is causing people to worry a little bit less, and thus again going into the put strategy rather than selling actual holdings?
So I would say this is the opposite of complacency that I'm looking at. I would say that people are getting into really big hedges really quickly. And remember, when somebody buys a lot of puts, they don't make any money when the market goes up. So it's tantamount to selling. I mean, when you hedge away all of your upside, if the market rallies, you need to get rid of those hedges. You need to sell puts or buy calls or buy more stocks, right, to be able to participate in the upside. So what it shows is that after 10 days, if you have an average put call of 1.14, I think you're basically, the reason why this threshold is what it is and has the impact that it has is because I think what it means is major institutional investors have more or less hedged away all their upside. So I think that's the opposite of complacency. I think that that's actually, it's a sign, as I said, I think that that's a sign that there's other sources of money coming in and bracing the market. So the fact that it seems like a small pullback is causing that is probably because, in my opinion, it has to do with the relationship between interest rates and dividend yields. So we're seeing the long only, equity only, cyclical equity side money managers with trigger happy on the bear side and no complacency at all. And believing, you don't hedge like that unless you believe the market is going to go a lot further down. So think of it that way. You're going to build into these hedges if you think you're effectively picking a top. And, because you wouldn't be in them if you thought it was a bottom. So they're building these hedges at the belief that this market is going to go much lower than it actually goes. But since they're doing it as a crowd, since they're doing it as a consensus move, they're hedging away the potential for the market to go down, because who are the sellers going to be if everybody's sitting there in big hedges? So then you get money coming in from again, I think maybe we're talking about some folks who would typically rather be in fixed income, but they can't find the yields right now, and you have a strong S&P average dividend yield, and I think you're getting some high floor action there. So I think that this is the opposite of complacency.
Okay. Just keeping a close eye on markets. Brett, the initial selling's cooled off a little bit. We haven't seen anything of a bounce back yet. Pulled back about 16 points off the highs based around those restrictions on looks like 28. Okay, that's just in regards to Chinese equities, the Chinese entities that were put into place. So,
let me ask you a question.
Sure.
Let me ask you a question. Do you think that I gather that you had picked up on the sense that there were some heightened expectations for a temporary deal this round of meetings? Is that correct?
Me?
Yeah.
A détente, which I think should be different from a deal.
No, that's fine.
I didn't think that
a
they
temporary
were going to
deal, like a stay of execution here.
Yeah, exactly.
Yeah.
Something
Okay.
that would be put in place that would keep the Trump administration from raising tariffs in October. I thought it would be something along the lines of China offering to buy a bunch of products. And, there might be a couple of things that we'd see going on behind the scenes that we weren't aware of, like a North Korea type move at all or anything like that. But I wasn't expecting any sort of a soft deal to be struck.
Okay, so let's say that there's a range of expectations that have to do with one, further escalation where things get a lot worse, to two, something where the parties get together, then they break apart, then they say, hey, we made some progress, but we're gonna add to our tariffs on October 15th, but we feel confident that things are headed in the right direction, sort of a non-factor meeting that doesn't change the course of anything, but doesn't involve escalation. Or three, something like what you're talking about, in terms of basically we postpone new tariffs, and it suggests an inflection in momentum toward maybe coming together a little bit more. Four would be a temporary deal, a soft deal that says we're going to really work out the long-term problems down the line, but first thing we're going to do is we're going to agree, like the Chinese attempted to suppose the other day, we're going to agree on the stuff we agree on, which is just a trivially true thing, and somehow maybe the U.S. reduces tariffs to 4 or to 5, there being a full and complete long-term deal. So there's maybe those 5 different outcomes. And let's say the market was agreeing with you that number 3 deal, which is kind of what you outlined, was maybe the base case expectation for this.
Right.
I would say that the news flow over the last 24 hours has put things to either 2 or 1, probably 1. In other words, things are getting worse.
Yeah, it would certainly seem that way. I mean, there was the story last week that we could break into a little bit because I wanted to talk to you about the Dalio piece, where it's just talking about the limiting of capital flows into China, and we certainly saw that with this yesterday's news about the restrictions on those 28 entities, because I believe the majority of them were in the MSCI index. So right there, if you're putting them on the restricted list, you're already moving forward with those capital controls, and that's why I thought that was a pretty important headline. It's certainly the market took it that way. I think to a certain degree, it felt like we saw a stronger selling last week on the rumor than we did on the actual news. Perhaps there was just a misunderstanding in the markets, but the tone going into this, I mean, it's funny though because like I feel like the tone's different from the Trump administration against the Chinese delegation. Do you catch that at all, or?
Sorry, what differentiation?
Well, it seems like the Chinese delegation continues to point to, we want to continue to talk with the Trump administration. We're prepared to work with them. And then, the Trump administration on Kudlow and President Trump last week were saying this, but then they keep taking actions that certainly suggest otherwise. And I don't know if it's just trying to put the pressure on them in front of the meeting.
China taking actions.
The Trump administration taking actions.
Oh, okay. So you're saying China's saying we want to play nice, and the administration saying we don't.
Correct.
Right.
It's kind of how I've been seeing it play out over the last couple of weeks, anyway.
Yeah, I mean, I don't know. It could be. I guess. Yeah, I mean, I think that there's political capital to be gained by appearing to be really tough on China. I think that's explained a lot of what we've been through for the last 2 years with this. Yeah, I'm wondering if the whole recent situation with the Houston Rockets and the NBA is actually maybe more meaningful than we're giving it credit for in markets. Because to me, it suggests another tool the Chinese have. Look at how they just controlled the way that the NBA initially reacted. Like that is the access to the Chinese market hasn't really been a big story here, but it could be.
Oh, it very well could be, and I think it has been like that for some time. Like, I know you love South Park, Brett. Did you see?
Oh, yes, I did.
Did you see the most recent episode where they were talking?
I will never look at Winnie the Pooh the same way.
Yeah,
my daughter has a Winnie the Pooh doll.
But I mean,
you'll never be able to see that episode.
The big storyline was how Hollywood kind of bends around. Their writing in order to get into China and stuff. So I feel like it's always been there, but I wonder if it's going to kind of whip back too, where you're going to see a lot more of, because I mean, one of the interesting things is I feel like this has been going on for a while, but now we're going to see a little bit of pushback. Well, if you kowtow towards the Chinese market and continue to work with them, then we're going to ignore you, and you're going to get a backlash from the U.S. markets on that.
Yeah, absolutely. No, it drives this continuing split. It only looks to get worse over a long-term period.
Yeah, which brings us to that Dalio piece with the talks of the 1930s, right? I mean, just he's talking a lot about the similarities going on there, and it really feels like we're going down that road more and more. I mean, we talked about it back in 2007, just, kind of comparing it to the 1929 crash, and, we're putting a lot of parallels between the 30s and current day, and the more we see things like this where it's really turning into a China versus the U.S. and the backlash on social media from both sides is pretty significant, and one has to wonder how much further of a wedge can be driven down where you got two countries just like pointing the fingers at each other on why the whole reason why you don't have this is because of them.
Yeah, well, I think there's second-order consequences, too, which is imagine that there's several 100 million teenagers in China right now, and they're going to grow up through their formative period immersed in a domestic cultural context that turns the United States into the evil empire.
Yeah.
And, I think about that all the time. Like 10 years, 15 years from now, these are going to be people whose identities are forged in understanding the United States as the evil power in the world, because that's the propaganda that they're being just soaked in right now. And we're forcing that situation. And that is not a good long-term prospect when you think about the future leaders in China, the future military in China, et cetera.
Yeah, it really embeds them. So, I mean, for anybody who hadn't had a chance to take a look at the Dalio piece on LinkedIn, it's pretty good write-up, but it's taken basically from some excerpts from his books. But one of the other things that he touched upon in that, Brett, was the investment in China. And, it's kind of based around the Equitable Act, which was put forth by two bipartisan senators, Rubio and I think it's Shaheen is the other one on the Democrat side, that would basically limit the amount of investments in Chinese companies that did not adhere to whatchamacallit, to U.S. Auditors being able to look into the books, basically just accessing these books and making sure the numbers that are being put out are indeed the correct numbers. So that's one thing that I'll be keeping an eye out on these upcoming meetings and moving forward to see if China would open that up. But do you got any thoughts on that particular side of the coin there, Brett?
No, I just think that it's another lever, and inevitably it appears as though we're in a game theoretic landscape, which means both sides are going to inescapably pull every single lever they have. And this is going to take a long time.
Right, and one of the things that cropped up when it was talked about the Trump administration looking into this was whether or not that they could do it legally, and through various methods they can. I mean, you have the looking for the exact acronym here. It's the what is it, Brett? The
IEEPA.
Yeah, the IEEPA, which basically
International Emergency Economic Powers Act of 1977.
There you go. Well, wasn't it originally put out in the 30s under?
I think that it was refined in
1917, actually.
Yeah. I think that it was put out, but it was the version now that's being activated is based on the amendments done to create the version of it in 1977.
Right, and basically under that, this does allow the president to put this into play, and what you would need to overturn it would be a 67 votes in the Senate in order.
The same thing that applies across the board to everything that defines our lives right now.
Yeah, exactly. Be Medicare for all.
It doesn't matter what it is.
Well, I would
whether
say
you're talking about impeachment or tariffs or anything, that's what we're talking about.
I would say
Two-thirds of the Senate.
The only difference is that this one is broad bipartisan support from both sides of the aisle. It's like it appears to be the one thing that they can agree on. So if this was to be put into play, it's very unlikely that this would be reversed by Congress at all, and that it would pretty much sail through, because I don't think too many senators want to be the ones on the other side of the aisle. I think it would be one of those 98 to 1 against votes type thing or something. And then the other area where they can put pressure on is the Federal Retirement Thrift Investment Board, which is basically a retirement investment board that is looking to invest in the MSCI All Country World ex-US fund for its retirement purposes. And what they can do is they could keep them from investing in that because of the Chinese entities that are enclosed in there. So this capital controls level is definitely an area where the Trump administration can exert maximum pressure on a lot of these ADRs and China in general too.
But let me just go conceptual on this. So this we can try to choke them further and see if they will simply give up and say, okay, we'll sign whatever deal you want. And that seems to be what this is about. This seems to be about the strategy seems to be to say, well, let's just go ahead and choke them down completely to our mercy and then give them the terms that we think are a good thing, and they will just be forced to agree to them. And that's been kind of the strategy, rather than shaping it from the beginning in a public messaging sense of let's find a win-win, and creating a context where people in China who are career politicians and bureaucrats of the state who can sell to their own people that they got a good deal for their country, who are willing to sign something, who are willing to make a deal with us on the basis that the avenue is still left open for them to have a future political career. Because at the end of the day, that's what we're talking about here. And I think this is just another way to continue this narrative of trying to say, well, we're going to create a situation where there's one winner and one loser, and everybody on the losing side is going to have no avenue to attempt to spin it to their domestic audience that they have created a better life for their citizenry. They're just going to have to basically say, we lost, we failed, and then wait to get thrown out of power. And that seems to be the strategy at this point, is to try to win in such a clear way that the other side ends up being destroyed, in terms of and if you think about going against a command economy with a communist political system inside a walled city where they control the internet, that's a particularly difficult thing to achieve. And I think that many of the people who are going to be on the other side of that table would rather send their country into recession rather than give up and be politically shamed. So you're creating this spiraling process where you're incentivizing people who are on the other side of the table to not agree no matter what, rather than giving them the opportunity to spin it to their own domestic audience as a win. And this is another step in the same direction as I would see it.
Yeah.
It seems unlikely to get results. We're going to be met with the same mysterious pushback, which is, it shouldn't be mysterious.
Right, and I just think that's been one of the problems with the approach from the current administration in terms of always trying to make it look like a win and that they beat down the other economy.
Saying there's a winner and a loser, and the loser's going to have to admit they lost. And in China, when you have such a powerful propaganda machine, when are you going to make that decision? Because the second you do, you're thrown out of power.
Exactly.
There's no way. Yeah, so they're just committing some version of suicide by signing any agreement we put in front of them. And it just does not seem like a likely step that's going to be taken.
Right. And just keeping an eye on the Powell headlines, just noting that the economy feels sustainable. No aspect is booming or hot right now. So that could be a little bit of a positive for commercial real estate.
It doesn't feel like Goldilocks.
No, it does. It definitely doesn't feel like Goldilocks, but I would tend to agree that nothing's like we've definitely scared the cockroaches out of some of the more overheated areas. I would say, perhaps golds would be one that you could take umbrage with. But okay, the final piece that we just want to touch upon, Brett. Obviously, next week we get into earnings season. Currently, right now, looking at S&P expectations, looking to fall 4.1% year over year. This would mark the third straight quarter of an earnings decline. One of the things that I was looking at that I found interesting was a PE multiple chart from Bank of America's Global Investment Strategy, where they have a flat EPS would leave us, if you're looking at a multiple of 16.5 right at 2,900. That's obviously been a pretty big level the last couple of days. They have a drop of 6% on EPS year over year, with the multiple at 16.5 times, which is the historic average, leaving us at 27.23. Now, we just talked about a fall of about 4.1%. Now, granted, usually the S&P on average beats by about 3% from expectations, which would leave us down minus 1.1%. But do you read anything into these multiples or the earnings declines that are expected? And also, on top of that, I would just note a lot of expectations from margins being declined too. And there was a great read by the Wall Street Journal basically comparing the BEA measures of income versus the S&P 500, where the BEA excludes a lot of the investment gains, and therefore is a little bit of a better read in some occasions. But also with some of the numbers that we've seen coming in here, some of those investment gains that the S&P had could come in a little bit more than expected, and thus perhaps even provide less of a buffer for those earnings beats that we usually see. So
by that, do you mean the financialization of the corporate economy?
Yeah, exactly.
Yeah, so that's not. I wouldn't discount that. That's the primary engine right now, isn't it?
Yeah, it definitely is. But again, I guess where I'm going with this, Brett, is how do you view this upcoming earnings season? And I know you're not a big valuation guy per se. You're a lot more of the mindset of positioning. And
I think they're entwined. So let me say that. I think that I view valuations as context dependent, and I think that I've made the argument before that I think if you think of it as policy, I think, is a big part of it, and we talked about the voodoo doll magic belief and the idea of whether or not there is a policy response that can be countercyclical if we start to see, let's say, the ISM as a leading indicator starts to show up into hard data over the course of the next several months that shows, we're starting to see precipitation of some more challenging hard data numbers in the economy. What's going to be the response for policymakers? And if people are at the point where they have stopped believing in the voodoo doll magic, they've stopped believing that another couple of interest rate cuts is going to make that big a difference, then are there tools other than that? Do we have a fiscal response? Do we have a politically functional system that's able to deliver that? Those are questions that I think the belief can be seen in the multiples. And I think we may be in a situation where people are underestimating where real returns come right now from companies. Maybe we do better than people are thinking, but the multiples are something that can shrink. So you might end up with a market that's relatively stable on strong earnings. But then again, positioning suggests that there's a vulnerability if we get some kind of belief that there is a countercyclical support. I've made the metaphor several times with trapeze performers in a circus and the types of tricks that you'd see when there's a safety net versus when you don't have a safety net, or if you think of tightrope walkers, where if there's a safety net down there, you see some pretty amazing flips through hoops of fire and all sorts of stuff. But if there's no safety net, then the trick is just not falling, right? And that's amazing drama for the crowd. But if you use the analogy basically with the types of tricks you use and the multiple that you have on the market, when there's no safety net down there, I think that you're going to see less likelihood of expanding multiples on better than expected results. So I think you would see a lower than long-term average multiple being a pretty easy thing to achieve during this environment if we see some hiccups in terms of economic data, because people maybe aren't confident in the policy mechanisms that we have in place as the support net.
Okay. All right. So I think, Brett, that's going to do it for us for the most part, but I know you'd like to summarize what we've been discussing. So before we do that, though, is there anything that I've missed here that you wanted to touch upon?
Well, I just want to address one question that just came into feedback, that I've been relatively quiet in terms of trading, despite there being relatively elevated volatility. And so I would just go back to something I've talked about a number of times, which is not all volatility is created equal. And when the volatility is in the direction of sentiment, that's one strike against it. And when it's all on headlines, and usually those two things are together, that's two strikes against it. So it's the best type of trading situation for the style that I employ is a high amount of volatility in a market that's past important headlines and is moving of its own accord, and particularly in a situation where there has been a sentiment imbalance in one direction or the other, and it is moving away from that imbalance. So you're basically draining too many people leaning one way or the other, and in a highly volatile move. And right now is basically the opposite of those characteristics almost across the board. We're getting a lot of negative headlines in a market where people are extremely bearishly positioned, particularly on short-term measures and particularly with hedging. So it makes it particularly difficult, especially when all of the important moves, and we've just seen, since we've been on this show, this broadcast, we've seen two different examples of it. Virtually all of the important moves are in immediate reaction to headlines just crossing the wires, rather than in, let's say, the eventuation of a sort of organic pattern construction where the pattern breaks and starts to move. This is just all a market bouncing around inside of a range, getting triggered one way or the other on some kind of tweet or headline. And that's just not an analyzable situation. You would need a time machine to beat that.
All right, perfect. All right, well, Brett, always a pleasure talking to you. It looks like we're going to just cut this short under an hour, which is generally what our goal is, right? So we'll be in touch, obviously, all week, and any updates that we see, we'll be sure to give people, and we will be posting this replay to the site in a little bit.
You got it. Thanks, Gav.
Take care, Brett. We'll talk to you soon.
Okay.